Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook and your host for about the next 20 minutes here on Options Guide TV. It's Fed Day, so we're going to look at a few trades that we have on. We put on a couple of UNH trades. UNH hasn't moved a ton. The company is going to be announcing earnings here going into the beginning of the year. So we're looking to do a horizontal spread, or otherwise known as a diagonal spread, and that we're going to actually buy a little bit closer to the money option contract and sell a little bit out of the money. And we're going to go all the way out to that January expiration. We also put on a butterfly to try to get a little bit bullish on the underlying stock. And we're going to look at just doing a butterfly today. We're going to lean into the bear side of things, where the market is at right now, heading into the report here at 2. Well, the announcement usually is around 2 o'clock on Eastern time is the word that I was trying to say. And we're going to go a little bit bearish and see if we can get a little bit of a crunch in the implied volatility. Right now, we have the VIX index trading right at 617, actually, exactly right on the nose at this point in time. That's up a little bit, and that's usually a case heading into a Fed funds into a Fed meeting. And it's highly anticipated that they're going to cut by a quarter of a point. The big question is the market's kind of pricing in additional cuts going forward, and that's going to be the conversation. That's what everybody's going to be focusing on. The Fed chair's comments afterwards on is he going to lean hawkish or what is the next meeting going to look like? Because right now there's an extremely high probability they're going to cut by a quarter of a point. The Fed funds futures are saying about a 99% chance that it's going to happen. All right, we're at 17 on it. So let's get into the UNH trade, because we did say that this is a shorter term trade. We did 2 different trades. Wanted to get a little bullish on the market. This is the chart that we have on UNH. Here's the downtrend that we saw. Here's the gap that we already traded once. We traded from the breakout here all the way up to the filling of the gap. It didn't continue, though. I was anticipating that the stock may break through that gap, but it did not. And we actually have had, let me zoom in this little corner now, okay, on the Tradier charts. Okay. And so then we actually had, this is actually called a death cross. So we had the positive 20-day crossing over to 50-day, and now it's came back over and it's crossed below. Now, I don't think of this as, what's the word? As important as when you see the 200-day crossing over the 50-day. So this is going to happen more often because they're just shorter time frames. But it did mark a downturn here, and the market ran down, and now we're kind of turning back up on this, and we're hanging out within this range right here. So here's where we're at, hanging out between the 20-day and the 50-day moving average. And since we put the trade on, the market has came down a little bit, still hanging flat, hoping that the 20-day is still going to hold right here and bounce all the way back up towards the 340 level. And that's actually what we targeted on our trade. So let's go look at the what if calculator and the strategy that we have set up here. Here's UNH. Here is the butterfly that I want to focus on. Now, the what if calculator is not showing as of today, but with this strategy, it really just matters at expiration. So here's what we got. The market right now is at 323. Here's the UNH trade. We bought the 325, sold the 340. Remember, that's the top. That's right where that 50-day moving average is at. Hoping that the market would drift this way and we get a little bit of time decay. We have the 19th as the expiration, so we still have 9 more days left in that trade. We put it together on Monday, but we are down on the trade. We initially paid about 576 for it. So that's the wrong number here. And now it's at 514. So we are down 60 cents on this trade. Yeah, about 60 cents so far. But I let the trade ride. We're still in there. There's nothing on the chart that scares you at this moment. If we break below the 20-day, you could say, well, in the shorter term, that's showing a little bit of weakness in the momentum. But still hoping that the trade comes back up and lands within that range. Right now, it's a little bit of a discount if we wanted to come back in and put the trade on it as of today. So if we still look at the chart, and I'll just show you, this is where we're at. And once again, 340 is the upside. Go back to the what if calculator. We sold our precipice right here, right at 340. If that's where the market lands, somewhere close to that, the maximum upside that we can make on this trade, or the most that it could be worth, is the difference between the first strike, the 325, and the 340. So the most that it could trade for is 15. And we paid around $6 for it. We'll call it $6. So you can make around $9 on the upside if we landed right there. And if we go above and beyond and we break through the 340 level to the upside, we can make the difference between the long spread, which is 15 points, minus the short spread, which is 5 points. So that means this can trade for $10. If we paid around $6 for it, we can make close to $4 on that trade, approximate. Okay, so that's what we're looking to do. Now, we also went out and did a time spread, which isn't showing up in the calculator right. And it's trying to get this thing to work before we kick the show, but it's not happy about it. So let me go. Let's back out and let me grab this trade. Let me grab the screenshot because we had the proper P&L chart for it. So here you go. And go ahead. Now, this was Monday's show. There isn't too much difference except for the market has gone down, but this is the way our diagonal spread looks like on UNH. We bought the 350 strike. Now, this is a screen grab from Monday, just so you know. This is a screen grab from Monday. And we bought the 350 strike and sold the 355. Now, this expiration is January the 26th, and this is December 26th, and this expiration is January 16th, which happens to be the day after the earnings report. So our concept is that we're buying this option contract with the anticipation that implied volatility will go up, and we're selling this option contract with the anticipation that implied volatility will stay the same or drift lower, and we'll get a large rate of time decay on the shorter term option. Right now, this entire trade, so I guess we can just do this, is now trading at around $5 too. So we're 513 on that trade. So we're down just a smidge on this one too. So send to ticket. Yep, that's there. 514 is where the midpoint is at. And I would continue to ride this one. We can actually sell another shorter term option against it. If this option contract, the December 26th expiration, I'm pointing to the bottom of the screen, December 26th expiration, if that expires, we can also go out and sell the next week out. So we got some options with this one, and we'll ride that trade. Okay. Now let's do in the SPX. Now we're flat on the day, and let me check it over here on a different source. We were down a smidge, so the markets are just kind of waiting. So I'm willing to lean either direction. I just want to sell some of the vol premium. Right now, the VIX is trading right around 17. The shorter term implied volatility is fairly high. The 1 day vol. So I'm looking to do a butterfly, and always liked with the butterflies to lean the direction of the market, but the market is basically flat at this point in time. Up $1 is what the derived value is showing inside the platform, up $1.20, and that's fairly close. The real time I'm seeing 68 6,842, a couple of points higher. So which way do we want to lean? I don't think I've ever done it on the show where we're sitting right at, we don't have any directional bias. Okay, so maybe we do, let's see what 15 points wide looks like. Maybe we take this hint and we go neutral on the market. 68.40. Let's 1 day option contract. Let's get to the right expiration. December 10th expiration, end of the day, 68.40. 15 points is here. Look at the time premium that's still in this at the money option contract halfway through the day. That has to go away, right? We're got about $1. Well, we got $3 worth of intrinsic value on it, and we're trading for $23. So this is still trading easily for $20 plus. And I want to look real quick like at where this is at, and then we might lean a different direction. Okay, 40. That's too cheap. $0.55. 1 day. $35. This is 15 points. All right, there we go. 45, 55, 60, and buy. And then we'd sell 2 of these. Oh, that's not bad. So we got some pumped up vol. Let's send that to the what if. Make sure I got the strikes right. Yeah, we got something screwy going on inside the calculator today. But yeah, that 165. Okay, so I don't mind this at all. We might lean. I'll okay, at 11:20, 2 o'clock is when the event is. This is a 30-point wide butterfly, centered around 68.45 in the SPX, and we're paying $1.65 for it, $1.75, which is fairly cheap. I have to admit, not bad. $2 now. Let's move in a little bit. We'll say 170, and that'll be our trade. So 170. So $170 per 1x2x1 butterfly. That'll be our max risk. Our max upside would be 15 minus 170. We're looking at 1330. But if we put this trade on, as soon as that announcement happens, we're going to want to get out right at 2 o'clock whenever we put the trade on. We're getting some pumped up vol. That's why the butterfly is a little bit cheap. Not bad, not a bad price to be able to pay, but you got to think that the market's going to stay within a 15-point move, okay, to the upside or to the downside. You can go a little wider if you go 20 points, which would mean a 40-point landing zone that you're going to be fairly okay in, right, depending on what you pay for it. But it's going to be a lot more expensive to go 40 points wide than to go 30 points wide, which would be a 15-point wide butterfly. Now, if we lean, let's lean bullish. Market's kind of moving that direction right now. Let's clear this out and go 15 and 10. So 645. So here's the 30. Hit 2 of the 45s. And then the short spread will be 10 points wide. And we'll buy that. Yeah, that's a little bit. That's more where I thought it might be. On this trade, we're at 650. I don't like this as much. 645, 68.45, 68.43. That's too expensive. And 340, 650. Yeah. If we pay 650, that's just too much to pay for the trade. I don't want to do that trade. That's too much. If we did it a little bit earlier, we could have got it off like I said, around 10:30 today. This wouldn't have been a bad trade, but it's a little bit too late in the day. It's 650 is too much to pay for it on a 1-day basis. So let's go back and let's look at the what if calculator. Go back to the normal butterfly, send that to ticket, and all right, so 170 is our max risk, hoping that the market stays within 15 points to the downside or 15 points to the upside. As soon as the announcement happens is when we'd be looking to get out. We don't want the market to move hard in either direction. And let's just move these strikes one. We're going to move this down to the 68.25. And we're going to move this up to the 65. 20 points wide. Now we're $3. So we're going to pay. Do we want to, is it worth doubling the cost, a little less than doubling, 170 versus $3 to go 40 points wide? Your break even would be 6,862. So it would be 65 minus 3, or 6,828. Send that to the what if calculator. Let's try on it a little bit better. We'll zoom in. Yeah, these would be the two trades I would do on the daily base, or to play the Fed meeting that's going to happen today. Highly anticipated 0.25% rate cut. Implied volatility is raised because of the potential news, hoping that the markets stay within a range. And in this instance, the range would be 20 points wide to the down, or 20 points to the downside, 20 points to the upside, or 40 points wide, minus the net debit paid $3 on the trade. Fed is going to speak at 2 o'clock. At that point in time, you should see vols come in a little bit. No matter what happens, get a little bit of a decrease in implied volatility. And that's what this trade is really about. And then time decay is going to be huge. The maximum it could be is $20 if it goes out right at expiration. We're using the SPX, so it's all cash settled. I like the SPX way better than the SPY because of that. And that at the end of the day, if cash is due to you, it shows up in your account. If there's no cash due to you, then nothing shows up in your account. It's that simple. There's no buying and selling of the S&P 500 index. Would you normally roll a vertical spread or close the whole diagonal? I would normally roll. Okay, let's go ahead with at Dougal. I would normally roll, especially on the vertical spread heading into earnings. You always have the catalyst of earnings that could save the trade. So if I have the vertical spread on, and we've only gone a couple of days, I would look to close the short option contract, and you can make a gain on that if you'd like, and then you can just ride the long option contract if you'd like, or you buy to close the short and then sell the next week out, or even roll to the expiration of your long option. So there's just a whole bunch of things. This is part of the reason why I like to do these around earnings. And so let's go back to the UNH spread. It's just the profit and loss graph isn't drawing correctly today. But so the 355 is your focus. The 355 has a short-term expiration, the 12/26 expiration. So let's send that to ticket. Let's go over here. Let's type in UNH. And if we're looking at the December 19th expiration. 26th expiration, 16 days away. So this is $1 still. So there's still a lot of time premium in this 355, but what you could look to do is buy to close this and sell to open the January 2nd expiration. Or if there's not enough premium and that doesn't make sense because the market's moved too much against you, you can roll to the January 9th or even get crazy and actually roll out to the 16th. So you have these different expirations that you can still sell some premium in to try to offset the risk of your long option contract that expires on January 16th. So I like to do that on the roll. Now, it's okay to just get out of it, say, okay, it's moved it too much against me and I just want to get out of the trade. And that's all right. So if you paid $5.50 for it, you're looking at $2.75 to be at the midpoint. But when I usually commit to a diagonal spread like this around earnings, I do expect to pump up an implied volatility on the January expiration, and that's going to help me a little bit. So that's going to start happening once I get down to about a week out, about 10 days to 1 week. All of a sudden, implied volatility usually will increase a little bit. Right now, it's at 35% versus 30% on the nearer term option contract. So I would expect it to generally creep a little bit higher as we get into the earnings report. So that's simple. All right, Kurt. Kurt, good morning to everybody. Is there any other trades on the UNH trade on the time spreads? Well, it's actually a diagonal spread. It's hard for me to not say time spread because I just think that we're doing different expirations, but we're going diagonally on the chart because we're going different expirations and different strike prices. All right. So we'll come back on Friday and we'll make the official paper trade. We're not going to do the more expensive one. I don't mind paying $3. I personally don't mind paying $3 for it on the SPX one. But this is the 15-point wide one. And that's 160. Yeah, if you're just going to do one contract, this would be something I'd be willing to speculate on. 165, we'll call it 170. That's about where we were at. $170 for a 1x2x1 15-point wide butterfly heading into the Fed announcement at 2 p.m. today Eastern time. That's going to be our official paper trade. We'll take a snapshot of the market after the announcement, and that's the trade we're going to ride with. So thanks for tuning in for Options Guide TV. We'll be back on Friday to see how the Wednesday trade panned out, and we'll look at a new trade on Friday. So thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.